Welcome to this webinar on church accounts. My name is Ian Wakeham. I'm the financial management manager of Bugby, otherwise known as the Baptist Union of Great Britain, and I'm joined today by Alan Hargreaves, who is the head of training for ACAT, that's the Association of Church Accountants and Treasurers. Today we're going to be looking at how to prepare church accounts. Now, if you're watching this live, there is an interactive Q&A which is available throughout the session. And even though it is live, you can still pause and resume the presentation at a later time. Now, of course, in recent years, there's been a lot of significant changes in reporting for charities, and there are more on the way. For example, in March 2021, all churches would have to register with the charity commissioners and therefore submit accounts in a particular format. Basically, the only charities exempt from registration and therefore compliance with this will be the smaller clubs such as our societies, sports clubs, local uniform organisations such as the Cubs and Scouts and Girls Brigade, all those having less than £5,000 per annum. So without further ado, I'll pass over to Alan, who will take us through some of the definitions and requirements of church finance.
Thank you, Ian. The main thing we need to talk about today on this matter is, firstly, is there any difference between charity accounts and ordinary secular accounts? And I think we find that there is. What do we have the next bit down? Certainly, in the case of terminology, there are words which are used in the secular sense which we'd not expect to find in a church sense. For instance, businesses, which can be either individuals, partnerships or limited companies, are out there for the purpose of making a profit. Churches can't be individuals, they can't be partnerships, they can be companies, and they can be trusts. They're not out to make a profit. They're there to exist for the purpose of advancing God's kingdom, and consequently the whole terminology for a secular account will be inappropriate. We'd expect to find in a secular account a profit and loss statement. This, of course, records how the business is doing throughout the year. Are we doing very well? Yes. If so, we make a profit, and there are things we can do with that. Have we sustained a loss? Things have not been so good, in which case we need to do something about restoring the company to equanimity and to work out how we're going to deal with that. Secular businesses, because they're profit making, very often make their money by way of trading. Contrast that with churches. What can we sell? We can't sell God, he won't allow us, and it's inappropriate to do so anyway. So there's another word which we'd reasonably not expect to find in church accounts. It may be that we do some trading, of course, to raise money, but we'd have to make totally different arrangements from those than we are for our normal church activities, which are essentially based on free will offering. Secular businesses, they pay corporation tax on their profits or income tax if they're individuals or partnerships in business. Of course, the canard which is said is that charities never pay tax, they're exempt from tax. Well, we'll see at some stage that that's not the case. If they're not acting charitably or their income falls outside certain areas which are specifically provided for in the Taxes Acts for exemption for charities, well then generally they don't pay tax, but they can if they don't fulfil those rules. Profits are all about the interests of those people who are conducting the trade, and generally they will be the shareholders if it's a company. At the end of the year, the shareholders are entitled to have a share of those profits, and this is referred to as a dividend. In a church, of course, then we don't share anything at all in that way except fellowship, and fellowship costs nothing. So that being the case, we find yet again an essential difference. Let's just run through the church account side and see how it comes out there. Here we are, in direct contrast to a secular organisation. They are non-profit making organisations. We don't seek to make a profit. We may have surpluses, we may have a deficit, but we're not there for the specific purpose of making a profit out of our activities. Because of that, it would be inappropriate to call our heading of our accounts a profit and loss statement. Instead, it's an income and expenditure account or a statement of financial affairs, depending on the size of your church and its turnover. Generally, we're not trading, and so we don't need to worry about trading accounts and adjusting for where our stock is and such like, because we haven't got it. Generally, they're exempt from corporation tax, as I said, but of course, if they stray outside their objects, well, then they will pay tax on the amount they spend accordingly. Surpluses cannot be distributed if we make any, but they must be ploughed back into the charitable objects of the church. So then we've got some quite significant differences there. We're talking about a totally different kind of organisation. In addition, charities have to comply with the regulations, the Statement of Recommended Practice for Accounting for Charities, which introduces the concept of fund accounting. It is easier to be the financial controller of a secular organisation than it is for a charity, because a secular organisation is only interested in, has the money for our sales gone through the till? Well, we don't make sales, but we're interested that we get all our money that we're entitled to, but then we have to consider where it came from. And this is at the heart of fund accounting. So what does fund accounting mean? As I said, the Statement of Recommended Practice for Accounting for Charities requires charities to report their funds under a number of categories. The first are unrestricted funds, are general funds in other words, and those funds have the main trusts of the church impressed upon them. There's nothing special about them. If we're there for the advancement of religion as we are, then we can spend unrestricted or general funds simply for the advancement of religion in any way we think that works. So it may be we pay our pastor's salary, it may be we pay the caretaker, the organist, the gas, the heat, the light, and so on. All the normal expenditure, nothing out of the ordinary concerned with the running of a church. The next funds, you'll not find these in many organisations unless they are charities, and they are designated funds. Now, these are actually part of our unrestricted funds, but they're a bit special. And the reason why they're special is because we've set them aside for a particular purpose. We, the trustees, have decided what we're going to do is to earmark those funds for a particular purpose. But it's our decision, and that's one of the keys about that. Restricted funds you will not find in any commercial organisation. They are funds for which we're obliged to spend them in a particular way. If we didn't spend them in that particular way, then we'd be in breach of trust, and that would cause us grief and trouble, believe me. So restricted funds are a special category which you only find in charity accounts in general. Finally, endowment funds. Endowment funds are a particular kind of fund which are to do with having capital put on one side for a particular purpose. We can't spend it, we can only spend the income, and generally then in accordance with the wishes of the person who gave us that money. So those are in broad terms the four funds that we're looking at, and now we'll have a look at those in a bit more detail. Unrestricted funds, as I said, are all about just money which has come in for our general purposes. So when you have a collection at the offertory on a Sunday, those funds there, unless any special announcement is made, are unrestricted funds, and they can be used in promoting the church's charitable purpose for the benefit of the public, or in any way which supports it. So that's quite a wide way of using those funds. But when I say wide, of course, we've got to bear in mind that we're only entitled to expend monies on our charitable purposes, so they're restricted that way. Designated funds are part of our general funds, but we have decided, generally as a matter of housekeeping, to set aside a specific sum for a specific project or activity. So, for instance, If we had to replace the boiler this year and it costs us £15,000, we might say what we should really do is allocate some of our general funds each year so that we're not caught in 10 years' time with an enormous bill, by which time it might be £20,000 and we have to start scraping around finding that money. So these are our housekeeping funds, and we can have a number of them. We might decide this is something whereby we want to have a boiler designated fund. If we're lucky to have a decent organ, well then of course we're going to have to make arrangements from time to time for its tuning and its repairs and rebuilding. So we might have a designated organ fund. Any activity which recurs over periods of time, we could have designated funds. But they are our housekeeping funds. They're set aside for a specific project or activity. And the beauty of these is that if something happens in another area of our church life which requires money spending on it, then we can raise those designated funds. We can undesignate them if we so choose to do so. Unrestricted funds are those where we draw our reserves from. What are charity reserves? They're part of the charity's unrestricted funds that is freely available to spend on any charity's purposes. Now, the whole point of having money for a charity is to spend that money to achieve the objects. It is not an end in itself to build up endless amounts of cash so we look rich. If we're looking rich, very often we're not doing our job properly. We're not advancing the gospel at all. So the commissioners expect that if churches are going to have money knocking about, that they have a reserves policy, and they must justify that in their annual report and state it as a specific thing. Here's a typical reserves policy. The reserves policy of any town Baptist church is to hold 3 months of all expenditure plus a further 3 months staff costs to allow the church to adapt to any changes in the income or expenditure of the church. So that's pretty straightforward, that is pretty general, but it does show that the trustees have actually got a policy of why it is that they're holding cash in the bank. Restricted funds are our special animal. They're very clear to us. And restricted funds can arise in one of two ways. Here's a definition of one way. Funds held for donor specified purposes which have been the result of an appeal which the church has made for specific objects. So it could be, for instance, that we are asked to contribute to a fund to restore the organ. If you're interested in music, you like singing in your church, you're more likely to put money into that than you would be for other fabric-related matters. So that gives us some clue about what the donors think about what we're doing. And because we've asked them for that money, and as I've said, it may well be the case they put more in because we've asked for a specific purpose, then we're honour bound and duty bound and legally bound to use those funds only for the purposes which they were given. That of course applies to grants as well, because if we make a grant application, we have to say what we need the money for. Because these funds can only be spent for the purposes which they were given, well then we have to account for them separately. And we are stuck with those funds until such time as they're expended, unless, for instance, we go to the Charity Commission because it's abundantly clear we've over budgeted for something I think has been oversubscribed, in which case we must go to the commissioners and ask them for an order to spend those monies on something as near as you can to the purpose for which they were applied for. Endowment funds, they are there to be retained, funds held on retention as it were. Firstly, the capital which is given, the income generated to be spent on either unrestricted or restricted purposes, depending upon the donor's intentions at the time of the gift. But these are very clear very often. They come from wills or lifetime gifts. But when the money comes along, they come with specific purposes and we must spend them on those things. The capital is, of course, the core part of that gift, and therefore that must be preserved intact. So we've got some idea now of the kinds of funds we're going to have to deal with separately from that which a commercial organisation would need to do. So let's see how we need to prepare our accounts for a charity or a charitable incorporated organisation. Let's look at what we can do and what we can't. If our income is less than 25,000, well then we can prepare accounts on a receipts and payments basis, and we're not required, according to the Charities Act, to have any kind of audit or independent examination at all. In the next band, because as we do charity accounting and charity law, we can see that size matters. And as we go into different bands, then we're obliged very often to change either the way in which we do the accounts or to change the way in which they're examined, and sometimes both. So if our income is exceeding 25,000 but is less than $250,000 in a year, well then we can do receipts and payments or the accruals basis, but we are required to have an independent examination, and in some cases it has to be a person who the trustees consider to be competent in a particular way. By the next band, income of over $250,000 up to $1 million, we're obliged to do accruals accounting, so we can't just do receipts and payments, and we're required to have an independent examination, and it must be in that case by a person who has got a professional qualification which is recognised for those purposes. Okay, so those are the bands within which we must work, and you will see that the size will dictate effectively what we are required to do regarding either the method of keeping the accounts or the way in which those accounts are examined. If our assets are over 3.26 million, well then we're obliged to have an audit in any event. Looking at the table now which is on your slide, let's look at the difference between what we're required to do between receipts and payments accounts. Remember, this can apply to the very small churches and charities, or accrual accounts, which must apply to the larger ones in any event. What is the principle of it? Well, on receipts and payments accounts, you only put in as income what you have actually received. And similarly with your expenditure, you only put in what you've actually spent. Accruals accounting is different. It goes a little bit further than that. What it says is that you can recognise expenditure when the liability has been incurred. In other words, you haven't actually paid the gas bill, but it's arrived. Or sometimes you consume gas and the bill hasn't yet arrived, but you know that there is a liability to make expenditure there before you've actually written the cheque. Income, you need to recognise that when your entitlement to it is reasonably certain. So it may be the case, for instance, that you get a letter from a solicitor saying that you're going to receive a legacy. And if you believe that that's going to be paid out within a reasonable period of time, then you could recognise it in your accounts on the accruals basis. Let's look at examples of those two basic principles. When you put in your gift aid claim, well then you created a liability for the revenue to actually pay you because you put in a claim, so they owe you money straight away. Under receipts and payments accounting, of course, you wouldn't put it in your accounts until the cheque actually arrives in your bank account, and so on. If, however, you're doing accrual accounts, because you've triggered the revenue's liability to repay you, well then you would put in your gift aid repayment, even though it hasn't been received, and there'd be an opposite entry there that you would have somebody owing you money. Receipts and payments accounts are not complex at all. Anyone can do them. It is really a question of writing down in the book or putting on your spreadsheet transactions as they arise. Accruals accounting there is a different issue, because you need to understand and think about what really is happening in our financial situation here. Have we got a liability we haven't yet paid but is crystallised? Is money going to come into us which hasn't yet been paid to us but has been crystallised? For instance, when we issue an invoice for the hire of our church hall, we may not be paid until the end of the accounting period or the next one, but it is down in our accounts as money to which we're entitled to. Having two separate ways of doing accounts, which, as you can see, are radically different, means that the accounts will in fact look very, very different. If we've got our gift aid actually paid to us, well then the accounts will look good, because there you've got an income stream which has come in, and of course your bank account will be enhanced accordingly. But on the same issue, if we put our gift aid claim in but it hasn't yet come, on accruals accounting we put it in as income, but we'd have nothing to reflect that yet in our bank account. Fixed assets for receipts and payments accounts are only treated as expenditure. We don't do depreciation for receipts and payments because it's almost fictitious where this particular method of doing accounts is concerned, because nothing's happened which has a financial impact. When we're doing accruals accounting, well then we do need to take into account the fact that our assets will be depreciated and consequently required to put in a figure for depreciation and the policy on which we've decided that that figure is appropriate. That broadly is the way in which we can make decisions about how we do our accounts. Are they going to be on receipts and payments, or are they going to be on accruals? Sometimes we are required to do accruals simply because our expenditures, our income has gone above a certain level. Now, the third thing we need to think about, because we've gone out through our fund accounting, we've gone through the format of the accounts, the base on which we're prepared. The next thing is to consider that last thing, which is who can examine the accounts. Now, between 25,000 and £250,000, the Act is very, very simple and helps us. It says an independent person, that's a key word, independent, who is reasonably believed by the charity trustees, so it's their judgment, to have the requisite ability and practical experience. So it's not just academic, you've got to have done it to carry out a competent examination of the accounts. That's what the Charities Act says. It doesn't say anything about formal professional qualifications at that stage, because they don't need them. But of course, I mentioned some key words, one of which was independent. So obviously, a man who is a trustee of the church cannot be an independent examiner because he's examining his own accounts. Neither can it be somebody who is involved in the administration or leadership team of the church, because again, they'd be examining their own work. If a person has made a major donation to the church, he probably is insufficiently independent, because he's probably come along with that donation, if it's a big one, and said, and I would like you to spend it in this way. Of course, our independent examiner is really reporting to him to show that the money has been spent in the way that he said, just as much as to the general congregation as well. Neither, and this is a very important thing, can an independent person, an independent examiner be a close relative, partner or employee of any of those people who are set out above. It can be a member of the church, but obviously not a trustee, not an employee, not a member of the leadership team, not a major donor, or somebody who is related to any of those people. So you can be a member of the church and can be an independent examiner for that level of income. When you get to income over £250,000, then the Charities Act is a little bit more onerous on us. It's an independent person who has the requisite ability and practical experience to carry out a competent examination of the accounts, as we said, but they must also be a member of one of the recognised accounting professional bodies, and there's a list of those in the Charities Act. you would expect to find chartered accountants, certified accountants, chartered company secretaries, and so on, and members of the Association of Charity Independent Examiners. But equally so, they must be clear that they're not breaching their professional body's rules by accepting the role of being the independent examiner to your church. Just because they're a professional person, they still must maintain their independence. So we can't say special rules apply. Again, it must not be a trustee of the church, an employee, somebody involved in making major donations to the church, or be related by marriage, blood, or employer relationships with any of these people who are in the list there. But it still can be a member of your church. So your chartered accountant who sits in the pew has no role in the decision making of the church. He's just a person who to examine your accounts, not least of course because since he attends, he knows what is the pattern of giving, he knows what are your activities, he knows your church, and he knows what the congregation has been informed is the pattern of spending.
Thank you very much, Alan. Well, the Charities Act 2011 requires all charities to be publishing an annual report, a trustee report, but not unregistered exempted charities unless they are specifically required to by the charity commissioners to produce one. Now, the Act does actually require all charities with an income in excess of £100,000 to register. And so those charities by default must therefore produce an annual report. Churches whose income is less than £100,000 doesn't have to produce the report itself, but we would see that as being a good practice to actually produce one anyway. But things are changing because in March 2021, all charities with an income of more than £5,000 will be required to register under the charity commissioners, and therefore every charity over £5,000 will be required to produce an annual report alongside the accounts. Alongside the charity trustee report, if one is to be produced, the accounts have to also report an independent examiner's report or an auditor's report. And of course, with the accounts themselves, if they're accrual accounting, then the church must be preparing them under SORP FRS 102. That's for any accounts after a year end of December 2015. We've already seen that SOFA means Statement of Financial Activities. We also have to produce a statement of assets and liabilities or a balance sheet, and we also have to produce notes to the accounts. So let's quickly look through what is required within a trustee report. This is a big topic, so we won't deal heavily in it, but I'll just give you the main headings. There's a reference and administration details. This is to help the reader understand how the church is actually constituted, how it's actually organised, how the trustees are appointed, how they're trained, and how the church's decision-making and decision-making processes are actually operating. Under objectives and activities, this is to give a broader picture of why the church actually exists and what it is doing to promote its objectives, its activities, its projects, its services as identified as a charitable activity within the SOFA itself. Achievements and performance. This is intended to give an outline and assess the achievements of the church and must provide a review of the performance against the objectives that have been set in the past. This can be done both qualitative and quantitative comments. There's a financial review. A financial review is a review of the church's financial position and a statement of the principal financial policies in operation during that year. Now, within this section, we should also be seeing reserves policies, which we touched on briefly at the beginning of the webinar, on how much reserves a church can hold onto as unregistered, as unrestricted. Then there's also the public benefit statement. Now, this is at the heart of what makes an organisation a charity. By reporting on public benefits, charity trustees identify their charity as effectively doing what it was set up to do and making a positive difference to its beneficiaries. Plans for the future. This is where we summarise the church's plans for the future, the aims, the objectives it has set, and gives details of the activities planned to achieve them. But bear in mind, if you're starting to put items into the plans, then in subsequent years, you're going to then have to have a report on that within your achievements and policies. And then we've got information on fundraising practices. This came in November 2016, and effectively the trustee reports for larger charities over £500,000 must now report on how it does its fundraising. So let's have a look at some of the statutory reporting, and we'll look first of all at the receipts and payments basis. As you can see across the top, we've got different types of funds that we looked at earlier, whether it's unrestricted, designated, restricted, or of course there's endowment as well. And each of those is shown as a separate column. Now down towards the left, we've got different categories. Those can be categories as you choose and as you see as fit. They're not standardised in any shape or form, but simply require the church to split out the main categories of what you choose, both in receipts and payments. The detail you choose, but it should be sufficient and consistent both within the reporting and comparative years, both for income and expenditure. Now, of course, the comparative figures to the right-hand side don't have to be split out between the individual funds. They can be just picked up from the total column of the previous year's accounts. But as you can see from this example, it's easy to understand and provides quite a lot of detail behind each of these headings. And the reader is directed to extended notes within the accounts if they want further information. Now, notice here at the bottom, this is particularly important for receipts and payments basis. The statement is not relating to fund reserves, but is doing the reconciliation between the opening cash balance and the closing cash balances. There's no depreciation, there's no revaluation of assets, there's no accruals, there's no prepayments, because none of those actually have any cash elements in them. So we are doing a reconciliation between the cash itself. So there's an example of the receipts and payments basis of the accounts. We don't actually have a balance sheet within receipts and payments. We have something called assets and liabilities. It's a similar method to a traditional balance sheet, and you'll notice there's no fixed assets at the top of the statement. Rather, it's slightly further down, shown under assets used for church. And if you want more information about this style of reporting, have a look at our leaflet F02, which you'll find on the Baptist Together website. So let's have a look at accrual accounting, the accrual basis. This is following the SORP FS 102 format as prescribed by the Acts. As we saw with receipts and payments, there's still that requirement to show each of the funds separately at the top of the columns, the unrestricted, the designated, restricted, and endowments. But there are, going down on the left-hand side, there are standardised and specific headings for both the income and the expenditure. Now, non-operational items such as pensions, the gains and losses you might have on that, are reported separately and away from the normal activities of the church. Again, the comparative year figures don't have to be split out. They can be used as the total column from last year's accounts. And by using standard headings, it's much easier for people to start comparing between church accounts and other charities, even though that each church will operate very differently and maybe have different demands and financial practices. It also means that the reader doesn't get bogged down into the minutiae of the details, as they might do under receipts and payments method. Again, behind each of those headings, each of those categories, the reader is directed to more information referring to the notes if they want further information. And here's an example of the notes page. The funding columns and categories are replicated together with the comparative figures. And the purpose of these notes is to provide more analysis behind each of those headline figures that we saw in the SOFA. Support costs, which cannot be easily directly attributed to charitable objects, such as heat and light, insurance, stationery, perhaps maybe even salary costs if you don't apportion these already. These are reclassified of support costs across the individual charitable objects. And it's always a bone of contention as to the best way of doing that. Now, luckily for us, the SORP doesn't actually require and specify how this is to be done, except to say that it should be done and it must be adopted. And so whatever policy you choose to take must be reasonable and consistently applied. Now, whether that's allocating based on usage of resources or floor area of a particular activity, or the staff duties spanning a particular activity, whatever that might be, whatever is reasonable for that organisation. So whatever method you decide to adopt to apportion the support costs, charity should always balance the benefits of greater accuracy within the efforts of actually apportioning those costs. There's no point spending tens of hundreds of hours doing that, a minutiae of detail, because it's just a reporting requirement. And so we look at now the balance sheets. The balance sheet is a traditional form of balance sheets for most organisations. Obviously, a slight amendment making it more suitable for charity finance. We've got fixed assets, and then current assets, current liabilities, long-term liabilities. Pensions and liabilities are often reported separately away from long-term liabilities. And under the funds of charity, the report specifies the different fund categories. And these figures should actually be agreeing with the SOFA, the Statement of Financial Activities, as we saw earlier on the previous slide. And if you want more information on this style of reporting, then have a look at our leaflet F03 and the appendix on our website, which will give you a template for that reporting. Pensions has been a big area and has come to the fore over recent years, and needs to be incorporated into the accounts, whether that's receipts and payments basis or the accrual accounting. Accounting for pensions under receipts and payments basis is very, very easy. You treat all outgoings as payments. The future deficit contributions should be a liability in the statement of assets and liabilities. That means the liability value is currently the monthly deficit contributions multiplied by the number of months remaining in the recovery plan. And that's 120 months at the end of 2018. And there's further information on this in our leaflet F02. For accruals basis, accounting for pensions is a different kettle of fish. It's much more detailed, with discounted cash flows incorporated into the calculation. You record a liability in balance sheets calculated as the discounted cash flow of future contributions, which is recalculated every single year. using the FRS 102 calculator you'll find on our website there, or on the baptistpensions.org website. The deficit contributions charged against the balance sheet are as a liability, and they are reconciled each year with a change in liability value for payments made. The balancing value is recorded in the SOFA as a gain or a loss on the direct benefits pension liability. So here's an example. You have the opening balance for the 1st of January of £63,000. Deficit payments in the year is £3,000. The actuarial gains or losses, in this example, is a gain of £5,000, making the closing balance as at 31st of December, £55,000. So we come to internal reporting. However you produce the accounts for internal use, they don't have to comply with any SORP reliance, and they can be basically whatever you want, which is helpful to the trustees and members of the church for decision making and monitoring purposes. And here is a typical example of what income and expenditure account may look like for almost any organisation, whether they are a charity or not, except obviously there's that restricted year-to-date restricted funds on the right-hand side. This type of accounts can easily be produced by any bookkeeping system, providing you keep the restricted income and expenditure coding separate from the unrestricted codes, and can be suitable for the church meeting and leadership team. But unfortunately, this form of reporting is not SORP FRS 102 compliant, and therefore this set of accounts cannot be filed with the charity commissioners. So what about keeping records? Well, we must keep all relevant records which will substantiate the financial transactions. They can be bank statements and checkbook stubs, paying in books, invoices that we receive, any internal documentation that was created. They might be, for example, a weekly income schedule showing the different sources of income received. They might be also bank and cash reconciliations done on a regular basis. We might also have signed gift aid declarations, and keeping alongside that the weekly offering envelopes. So don't throw those away after every Sunday, when you need to keep them as evidence of that gift coming through. And then, of course, there's payroll records and calculations, even if that work is being done by a bureau. And most records will need to be kept and retained for a minimum of 6 years, plus the current year. So we're looking about 7 years, except for insurance policy certificates. These need to be kept indefinitely. But generally, as a general rule of thumb, 6 years plus the current year, and then you can start to dispose of some of those records. So do you need a computer? Well, no, you don't, but it will make your life easier, given the complexity that we've already seen in the charity finance and how we manage those different types of funds that we've talked about earlier. So what sort of packages should we be considering to using? Well, ideally, any package which is specifically written for charities in the UK. And of course, these can always be supplemented with other reports, any IT or Excel reports that you might generate for writing purposes. We wouldn't recommend that you use off-the-shelf accountancy packages unless you are skilled enough to actually configure them correctly and promote properly report for the charity commissioners. We are aware of some churches use the finance coordinator package from Data Developments. This is a UK church accounting package specifically for churches, but there are other packages out there that work equally as well. But there is one there for you to look at if you want to. And what about other resources? Well, we know and we've been aware that this has been a quick canter through the reporting requirements for churches, and we've only generally touched on some of the issues, and in particular the trustees' report and the relevant reserves policies. Now, there is a wealth of information on the Baptist Together website, which will flesh out more for you of some of the details that you may be looking for. Click on the resources, and therefore in there you'll find the financial tab, and then go to the number of documents relating to church finance, to gift aid and to taxation. And there are some specific leaflets which we have covered in today's webinar. F02, which is guidelines for charity accounts with income under 250,000. F03, guidelines on charities accounts with an income of over 250,000. F05, preparation of annual reports. And F07 on charity reserves. A whole range of additional information which is available on the Baptist Together website.
Well, the next resource which is available to all Baptist churches, because you are a block member and therefore every Baptist church is automatically a member of ACAT, is the material produced by ACAT itself. There is our website address, www.acat.uk.com, and you can go into the members area on this particular website because your union has paid for each of you to do so. In that area, you will see that there's access to our handbook, which is online, and there is also the opportunity to have our hard copy handbook, whichever you think is most suitable for you. The online handbook is updated as the law changes. The hard copy handbook is updated every 3 years, so it's always a good thing to go online when you checked from your hard copy handbook. In addition, you have the opportunity to submit any question you wish to the ACAT helpline, and you're normally answered within 24 hours, so that's pretty good. We look forward to seeing you.
Well, thank you very much, and we hope you found this webinar useful and beneficial. The slides are available on the Baptist Together website for future reference, as is the recording if you wish to listen to it all over again. And
we have some questions on the text that might be helpful if we could answer. So if I just plough on and ask, and if you could help our participants by answering them, that'd be great. I've got one question. I think this might be for you, Alan. It says, as a church, we set aside 10% of our offerings for BMS World Mission, Home Mission and emergencies or disasters. Are these restricted funds or designated funds, please?
They're designated funds for the reason that the people who decided to set aside those were your church members, your church council, and consequently the decision was with you. Contrast that with if somebody were to say, here is some money, I'd like you to, I want you to give 10% of this money for a specific purpose, then it will be restricted. But in the circumstances you said, then they are designated funds, they're your housekeeping to ensure that the mission carries on.
Next question, it says, this is on record keeping. Do we have to keep all of our weekly gift envelopes, or is it sufficient just to keep 1 week per year?
The rule is that you keep everything for the current year, and then you choose a representative month for the previous 6 years, and you keep that month. So if you choose September, because that's a general picture of the way your church works over the year, you keep your envelopes for September, and the rest can go in the bin.
Thank you. I think this question may have been answered after it was asked. But it says, do you have a suggested list of accounting packages that are designated for charities? I've inherited a version of Sage and I'm not keen.
Certainly, the finance coordinator from data developments is a good one to look at. They've also got, alongside that package, something for gift aid as well, so that can all be incorporated across the financial package. So it's the finance coordinator from data developments, but there are other packages available if you wish to try and source them out. But there's one to be getting on with.
Alan, any in your experience from ACAT that you'd recommend?
We can't recommend anything, of course, but what we can say is that people are very happy with data developments, finance coordinator. There are others as well. But the main thing is, as appeared on the slide, is be careful, because something which is for a business is not for a church. You need to have some means of separating out those 4 headings of funds: your unrestricted, your restricted, your designated, and your endowments. And it is possible to do that with a commercial package, but you've got to be pretty smart to do it. And if you go to something like finance coordinator, which is for charities, you'll find that that will in fact do that automatically.
In fact, it's written specifically for churches rather than charities.
Yeah.
Okay, well, that brings us to the end of the questions I have on the text.
So thank you, everyone who's joined us, and we look forward to seeing you on another occasion. Goodbye.